Hello, welcome back, and today we're going to be talking about realistic targets, what our goals are in our trading day to day, month to month. It's important to have targets set up in your trading. It's a goal that you have to achieve, and when you achieve it, you pat yourself in the back. And it's always important to have this little vision of where you want to get month to month, year to year. If you don't have that vision or the number specified, your goals are very up in the air and not solidified. So one of the things to do is have your monthly target set. You'll figure this out when you put your numbers into my money management software. You'll have your monthly pips, and that will stay the same, but what will change as your account balance changes will be the dollar profit that you take month in, month out. So as this account increases from 500 to 1000 over time, you'll notice $50 profit, and then when it doubles it's up to 100. It's simple, but the pips were still the same. Why is that? Because the position sizing changes as your account increases, okay? But monthly pip targets are very important, and what you should expect from the markets. Now, a lot of people will always tell you, or you'll see when they're selling things on papers and on websites and whatnot, that you can easily snatch 600 pips to 1000 pips from the market month after month. Okay, that's a myth. It's a load of bull. It's not realistic. I'm not saying it can't be done. It definitely can be done, but to achieve this month in, month out on a consistent basis is very, very unlikely. Okay, if you have too high expectations, you're going to feel let down every month. If you're aiming for 600 and you're only getting 400, you're going to feel deflated and you're not doing a good job. So it's important to have lower your goal and get that sense of achievement out every month. You know, the targets have to be realistic, okay, and achievable. So let's talk about this 600 pip philosophy. On this Euro chart here, it's a daily, and let's just say, I'm not saying that this is a trading system here, this is just a quick template that I put up. Let's just say you were trading here on this candle right here on the 3rd of the 7th. Let's just say you got a sell signal and then 30 trading days later, buying this candle that's just kind of pierced above there. That's 190 pips from here to here, and that is 20 trading days. Okay, that's a full month's trading. Okay, and that only gave you 190 pips. Now that is a daily chart. You could go down to a 4-hour chart, although the big move was the same. You could be picking up smaller moves. If you sold here, you would have made a move. If you sold there, you would have made the move. Take your profit, sell again. Because of this up and down motion, you can collect more pips than as opposed to the daily chart moves, because we're in, we're out, we're in, we're out. But still, 600 pips is a lot. It's too much, and accomplishing monthly will probably not happen in a day trading with full leverage positions. So we as day traders probably won't get that. You might get it as if you're a scalper with a different size leverage, if you're less in leverage, you collect more pips. You might have this little system where you're just snatching 5-10 pips, 20 trades a day at a lower leverage. You might be able to collect 600 pips, no problem, but the leverage is a lot lower, and they still might only be getting 10% profit throughout the month. All depends on trading systems and who chooses how to trade what. Okay, but you can collect more pips on the smaller time frames, but it is very noisy and very volatile on here. Okay. So the market moves in a cyclical nature, from trending to sideways to nowhere. To pull out 600 pips from a sideways market is hard to accomplish. We do not know the true tops and true bottoms of moves. We only try to catch the middle 1/3 of a move. What's the middle 1/3? Okay. Instead of trying to catch the very, very top, sell at the very bottom, what we do is, when you got the trend lines in, and then let's just say you place a trade on the sell, and then you bought back on this break. That's the middle 1/3 right there, from here to there. Okay, we're not trying to sell here and buy there. That's just not achievable. Okay, we always collect the middle 1/3 of a trend. That's good enough for everybody. The profit we take from these moves will easily achieve a 200 pips per month profit target, which is 20% our full leverage, which we'll go through later, and which is an accomplishment by itself. Increasing your account balance by 20% month in, month out is accomplishment. It's a good thing to do, and when you compound that over the full year, it's a very, very good thing to have done for yourself. 20% monthly compounded can grow to an excellent amount month in, month out. So we don't actually have to capture a lot of pips to benefit from a dramatic increase in our account balance. 1 to 200 pips monthly is all we need. Okay, so I set a maximum of 200 pips monthly. Okay, and that might be at my full leverage positions, which we'll talk about, or it might be just half the positions. I won't try to capture 400 pips from the market, because I know that's not achievable. No matter what leverage I set myself in trading my position sizes, it's always 200 pips. Okay, nothing changes about that. I recommend you do the same, set that, because the market actually moves in a cyclical nature. Like we said, winning streaks usually turn into losing streaks, because for a particular system, one thing might be going your way month in, month out, and then it will decide to change the trend, and then all of a sudden your trend following system stops working now. So that's why when we collect the pips after the month, we tend to stay out, be happy with your profits, stay at the market, let it do its thing, let it change its course, and we come back in at the start of the month fresh headed, as everybody else does. Because at the end of the month, the market conditions change as well, because a lot of traders in the financial institutions work by this monthly calendar of profit or losses. When they've made their profit, they'll exit their trades, and they'll stay out of the market because they don't want to start making some losses and then have to present it to the bosses after making winning trades, and then have to present losing. So what they do is, if it comes to the end of the month, they won't make any more trades. So you will notice at the end of the month the market actually starts to slow down. This is because there's less money in the market, because all the institutions are doing the exact same thing. Now you might not notice any trend changing atmospheres, you'll just notice a loss of volatility and the markets will start to sway about with no clear direction. Okay, so these are market cycles. They're all based month in, month out. Same goes for the end of the year, different times of year, holidays, summertime when everybody's out trying to enjoy the sunny weather. There'll be less money in the markets because they're all getting tied up with being on holidays and trying to see their family before they have to get back to work and whatnot. So there are all these cycles. So when you start your month, have your target 200 pips maximum. Once you've made it, get out, stay out, be happy, go and enjoy yourself like the rest of the people. The last thing you want to be doing is being in the market with the desperate losers that haven't made a profit. These guys are going to be very irrational, just trying to snatch any kind of pips, using their emotions to trade from, okay, because they haven't made their profits already, so they're desperately trying to claw it back, okay, so they're trying to whip trades out of everything. So the market usually becomes unpredictable, especially with the lower volatility, because there's nobody in the market anymore, because they're kicking back on the beach. Alright, so that's why we stay out. So let's talk about 100 pips profit at the end of the month. This is only 5 pips a day, by the way, just to point this one out. This is how simple it is, okay? 5 pips a day over a 20-day trading period, that's Monday to Friday, is 100 pips, which is 10% at full leverage, and 200 pips per month is just 10 pips a day, which is a 20% increase on your balance. So these are very, very small numbers, but because we're trading at high leverage, they actually increase and can also decrease the size of your balance at the same time. But if you play your cards right, you do things well, you have things on the positive side, then you will notice some differences, and you'll be well on the road to achievement, as long as you can maintain your trading style and emotions. So you need to go and think about what your expectations are, what you think you should achieve from the markets, what your dollar amounts are. Good thing is get that spreadsheet off me. It's my Forex Money Manager, and come up with what you need month in, month out from the trading. You might only need £100 a month, you might need 1,000, you might need £2,000 a month. These are all individual figures, down to yourself to make that decision what you actually need, based over what kind of period are you going to build this money up. You might give yourself 2 years of trading to build your account balance up to a certain amount of money. Let's just say if it's a $10,000 account, let's punch this in. $10,000, trading at 10-to-1 leverage, which is my full leverage, risking 3% on a mini account. Monthly profit target 20%, aka 200 pips per month. Okay. So with this current balance of $10,000, my full position size will be 10 mini lots. Half position sizes will be 5 mini lots. Now, what this will do is give me a $2,000 increase at the end of the month if I make 20% profit. Okay, a daily profit target of $100, and monthly pip target always the same at 200 pips, and the daily pip target, it's only 10 pips a day. Okay, change this to 20,000, still 200 pips, and still 10 pips a day. It's just your dollar amount changes. Okay, so if you become consistent, you're getting 10 pips a day, 200 pips per month. Okay, and as long as you can capture those pips daily, you'll get your dollar amount daily and your monthly amount every month, and you can start thinking about getting out your job. supplement your income to pay for your luxuries. But the key is becoming consistent and getting these daily pip targets down, weekly pip targets, monthly pip targets. Okay, it's all about being consistent and having the right system to achieve those targets. Okay, so key information: don't get greedy. Being greedy would be trying to get 600 pips out of the market. That's plain greedy, that is. So set a nice conservative target. If you're starting out, if you're not too sure, set a 100 pips target on your trading. You should be able to accomplish that. That's 25 pips a week. Now that's still going to be a 10% increase if you potentially get all your trades right, and you'll see on the next video what a 10% per month can actually do to your account if you compound it. I'm going to introduce compound to you. It's the eighth wonder of the world, according to Albert Einstein. And as soon as I came across it, it was like a little light bulb just went off my head, and it can show you the power of trading and over time how things can really excel massively in your favour as long as you get things right. Okay, and it's all about having longevity in the market. By doing that, you need to stay alive in the market, which means you always need to have money in your account to maintain this. So we always trade safely, trade with the amounts of money that we can risk and lose if needs be, because not every trade works out. As long as you trade safely, manage your money, collect your daily pips, you should be on the road to success over a few years' time. But it does take time, but maintain it, keep pushing at it, keep learning, and you should get there. So, but it's important to keep these monthly targets set. Okay, don't trade after you've made them. Keep your money, be happy, and don't set your targets too high, please. Okay, so we're going to talk about compounding next, which is a very interesting topic, and then let's see what it can actually do to our accounts on the next video. See you then. How you doing? Welcome back to the video, and today we're going to be talking about compounding and the effect it can have on your trading account if done correctly, month in, month out. What we're looking at here is my spreadsheet on my Forex Money Manager. This is the one I've got on the website for you, on the web page. If you've not got it already, check it out. But I've done two sheets here for you. First of all, this account over a 2-year period with no compounding. Okay, just going on a strategy of taking $100 a month evenly throughout the months. This is without compounding. That's what a lot of people might do. They might be happy with this $100 compared to, let's have a look at this one. Where's this chart? We have compounding put into place. So we use the start balance and the profit that we made to reassess our new position size, taking into consideration the profit that we made this month, and increasing the position size or decreasing depending on your account. But every time we get a positive, we increase the position size of our trading. So this month your position size would be 1.1, this month 1.2, 1.3, and so forth. This is basic compounding. Whereas if you were setting out for a certain dollar figure, $100 a month, it's easily done. But as you can see, as the month goes on, you start off with 10% profit, then it goes down to 9.1% profit, then 8.3. Even though you are still getting the same amount of dollar profit, your percentage actually goes down and down and down as your account balance increases. Now, as you can see here, you have a nice linear move up, nice and steady, looks all good, $100 a month onto the account, nice, slow, steady. So over a 2-year period, started off with an account balance of $1,000. This is fictional, by the way, and by 2 years of trading, that would be at $3,300 at $100 a month. Okay, that's straightforward, but with the power of compounding put into place, we have a same start balance of $1,000, and then throughout the years, 2 years, same again, same time frame, but this time the account balance is 8,952, still a fictional number. Okay, so you've got a difference of 330 to just shy of 9,000. That's nearly triple over the same time period. Now, as you can see, the dollar profit month in, month out increases, as does our position size. Your pip requirement will stay the same, and your percentage profit stays the same month in, month out. This is a steady 10% all the way through. Nice conservative number. If you're trading at our full leverage, that's 100 pips a month. Okay, so $100 for the first month, then 110, 121, 133, 146, and so forth, and it keeps increasing in value until by the end of the second year, month's profit is 814. Now you can imagine the difference if you were to take all these numbers down over 4 years on this chart. You would see your the account balance, dollar profit or losses will increase exponentially, as this exponential curve that we've got going on. It looks really nice compared to just basic. So this is what you want to do. You want to apply compounding into your trading, because you want to see your account exponentially increase like this. The more money you have, the more money you make. It's a very, very powerful strategy. You don't even have to do a lot to make this happen. You only need to know how to deal with the numbers in your account. So if we were trading at the $1,000 at the start, we'll keep this at 5 to 1, because the leverage doesn't matter in this respect. What will matter is the current balance, monthly requirement of percentage, and especially your position size. Okay, and the dollar profit comes into play here as well. Okay, so risk per trade is $15, sorry, at 30 pips using half a position size, and dollar profit of $100. Okay, so at the end of month 1, went up to 1,100. So we'll change that to 1,100. You'll notice the position size is about to change. It was at half a position. I'll punch that in. Now it changes to 0.55 for your position size on a mini lot. Now you'll notice the risk per trade has increased. This also increases the your profit targets as your dollar amount as well, and the profit for the month is now $110. Okay, so that's increased slightly. Month 2, 1,210, so we'll punch that in, $1,210. Now position size has just changed to 0.61, and risk per trade $18.15, so your profit target will be 1.5 times or twice that, depending on your trading strategy. Dollar profit for the month, $121. Okay, month 3, 1331. Punch that in. 1331. Position size now 0.67, $19.97 with profit dollars of $133.1. Okay, but you can see all this on the chart. I've got all the sums worked in here for you. There's little you have to do. All you have to put the data into the green cells here. This is the end balance at the end of the month. You punch this in, it will tell you your dollar profit. This is your requirement, so if you wanted to change that to 20%, you would change that to 20. That will show the next month you never actually did make the mark, so this percentage drops down. But we won't worry about that just now. Change that back, because this section is just all about compounding and how to compound the interest of the profit that you made the previous month. So if you have an account balance of 1,331, what I would do is round that number to the nearest 100, so 1300. If you have 1,464, round that down to 1,400. Always round it up to the nearest 400 or 50, depending on your accounts. 1610, 1600, just to make it nice round numbers. So that month you'll be trading position size, if you're trading at full leverage, position size of 1.6, 1.7, 1.9, 2.1 and so forth. Okay, but you'll be able to get all these figures from this. Change your account leverage to 10, that's my full leverage position. So for every $1,000 in the account, as we said before, trading with a one full mini lot, usually we're going for a 20% requirement. This is the numbers I work with. So when we get to $2,000, we'll be looking at two mini lots. So I'll put that in 2,000, two full mini lots. If I was halving my leverage, down to 60 pips, increasing that. So I'd need to decrease my position size, so I'd change from two full lots to now one lot. And if we want to increase the pips even more for big dramatic moves or swing trading, this will be your position sizes for that. So this little spreadsheet here is good for most systems. You can change this to 200 pips if you want to. That will give you the number for your position size. So it's got all of your all of the mathematics worked out for you in this little spreadsheet. So all you have to do is input the data in the green cells. So it is important to understand the data. It's good to know how the formulas work, but you don't necessarily need to know, because the formulas have been put into the spreadsheet for you. What you do need to know is your key numbers that you need to put in. Okay, current balance, position, pips at risk, and your position size. So I hope I've covered everything on compounding here, how important and how powerful it is. It can change your profit requirements and expectancy from this sort of line, very predictable, into an exponential curve like this. Now, as you can imagine, 1 year from here we're going to be trading with very, very nice numbers, and we'll be looking at, once you get to this level, when you're getting $814 a month here, you're looking at another 6 months, 1 year. You don't even need to think about work anymore, okay? Because you'll be covering that plus more. The thing you can do here also is, when we trade with 20% profit requirement monthly, I'll show you what that does to the figures. Okay, I just had to pause it there and now go and change a couple of formulas in the spreadsheet there. I've changed the profit requirement to 20%, which will be my goals usually, and I've done it over the same 2-year period. And as you can see, starting with the same balance of $1,000, 20% per month. First month will give you $200 profit. Compounding your position size to 1.2 after this one, and then 1.4 after this one, increasing the dollar requirement monthly. Now this is all a projection. Increasing. Now you can see 20% profit a month really does accelerate your account compared to the last one that we've done with the 10% over 2 years, was just shy of $9,000. Now as you can see here, as time goes on, this dramatically changes your account considerably. This is the difference with between 10 and 20% monthly over 2 years. We're talking from $9,000 to £66,260. That is just phenomenal, okay, with just increasing that 10%. The hardest part is getting started, getting out this little shell from the $1,000 to $10,000. This is the hardest thing, okay, because your dollar profit monthly is so small, you're not seeing any changes, okay. But this is the best time to learn. When you're in here, this is when you make all the mistakes and learning your money management and getting to grips with your system and finding something that works, okay. So this is your cost of education right in this little area for your after you become consistent and probably open up your third trading account, fill it up with another $1,000 and start trading seriously. No more games. Compound your position sizes. Don't take trades outside your systems. Stick to your plan. This is when you're going to be a real trader, okay, after you've done all your mistakes and paid for your education. Alright, your learning curve after that will be another year and a few months. Once you break past this $10,000 barrier, that's it, you're up into $2,000 profit in a month as opposed to $200. Okay, you're in the big money now, and you can see month after month how much this increases once you get past that level. Okay, look at this: $5,000, $6,000, $7,000, $9,000, $11,000 in a month. This is why it's so important to become consistent with your trading, okay, and not having these exponential expectations of 600 pips a month. I'm showing you right here, you don't need 600 pips a month. This 20% I told you relates to 200 pips a month, which relates to 10 pips a day over a 20 trading day period, 20 trading day month. Okay, and this is what could happen to the account. That's the balance figures there, okay. So this is why compounding is so amazing, okay. 66,000 compared to 3,300 at 10%, which is a little bit too less. Not compounding with, sorry, that was 10% now. This is compounding with 10%. Ended up with 8,952, and then when we compounded with 20%, 66,260. Okay, maths is very important in this game, and it's very, very powerful. Look at that curve. Okay, I know these graphs look great, but you need to get grips with your numbers. If you want your chart to look like this, you really have to know. And a good way to know is to get a hold of this money management software. If you don't have it already, you'll get it on my website, and just get to know the formulas, get to know the figures, these are your goals. Okay, this spreadsheet will tell you all, and just work with it month after month. When your numbers come in, month in, month out, you know, 1200 balance. Next month you might be 1400 balance. Punch it in, watch how it goes. 1500, 1800. Okay, you get to watch your progress on your chart based on your trading results. Be able to tell your profit percentage month in, month out. Check your trading history. Okay, and most importantly, based on your position sizes on your current balance and what your risk tolerance would be for your trades. And the most important part, is your position size compared to your account balance. Make sure you get this right, so you're not risking too much. It's a very fine line. You might choose one number too much on the wrong side of it, you might lose too much. So it's a very, very fine balance what these numbers are. Okay, so I hope I've covered everything on compounding. I really encourage you to go out, get this my money management spreadsheet. It's a great tool. It's a must-have tool in your trading. Okay, if you want to trade successfully, you want to compound your accounts, definitely get this software. So thanks for listening to this video, and I'll catch you in the next one. Thank you.